Looking ahead, we now have clear signs of recovery through, this is the, for those who are not familiar with it, this is a survey of purchasing managers. And a level of 50 is consistent with a recovery. And we're seeing both business activity and consumer confidence recovering, together with a continued pickup in equity prices. I think possibly they've slightly over-adjusted, but nonetheless, the effect is there, and it has a big impact on consumer confidence. And in countries like the US, rising equity prices do have an impact on consumer behavior. So to come to the key question, which is how strong will the recovery be? The first thing is we are seeing a bounce in the world economy and in production. And I know many of you are not economists, so I don't want to be boring and technical, but we have to talk about stocks and the stock cycle. When companies destock, and they destock to protect their balance sheets, then they can run production levels below demand. But eventually you run out of stock. And you have to, even if demand doesn't increase, you have to produce more. And that's what's happening at the moment. We saw it in the UK. Honda closed their car plant in January. When eventually they ran out of cars parked in the fields, they had to reopen the factory in June. Mittal Steel mothballed 16 steel plants around the world. They've now reopened 8, not because there's any increase in demand, simply because they've used up the spare stock. And that gives you an initial bounce. Secondly, there has been a very strong government policy response. In the first stages, this recession looked just like 1929, 1930. But then, governments believed in balanced budgets, there was no fiscal response, and interest rates stayed up. This time, as you can see, there's been a pretty quick policy response, with maybe a little bit slow in Europe, the ECB being slow to respond, but essentially a dramatic decline in interest rates to effectively zero. You may not be able to get any credit, but if you can, then it's very cheap. Secondly, there's been a huge fiscal policy response. This is government spending more to boost their economies. It's not as big as has been announced. Various countries actually counted pre-announced increases in spending as new spending, but nonetheless, with a very sizable pickup in fiscal policy. And thirdly, in some countries, particularly Europe, where there's a strong social welfare system, there's what's called the automatic stabilizer. As people become unemployed, then they go on unemployment benefit, and that tends to protect spending in the economy. Not true so true in the US, where there needs to be more of a policy response to protect people who lose their jobs. So the second factor causing the recovery is the strength of government policy. And I think we have to give credit where credit is due, and the policymakers have done a good job. But although we are seeing a recovery, and a quite clear recovery, there are all sorts of problems, and I think the recovery is going to be bumpy and slow and difficult. Firstly, because what we've had this time is not a traditional economic slump. It's been driven by banking crisis, and when we look at past banking crises, we can see that it takes years for lending to recover. And indeed, in the case of the Japanese banking crisis, lending's never really recovered. And that means that credit is going to continue to be in short supply. In addition to which, although in the US there may be sufficient cover for the banks, in Europe there probably isn't. And so we have this odd situation where the government is pumping money into the economy and the banks are just sitting on it. They're not spending it. And there's huge, what's called quantitative easing in the UK and US, when essentially the government is printing money. The banks are not spending it, they're sitting on it. They're being very cautious indeed. Households are still in a hugely precarious situation, in part because of their perceived fall in wealth. And again, in the UK and US, Spain, the loss to household wealth is nearly equal to the entire value of GDP. And businesses and boardrooms, I think, are going to remain very cautious. So I think it's unlikely, we're unlikely to see, as is normal after a severe recession, it takes a long time for business spending to recover. And a lot of the government policies are of a temporary nature. And in many countries there are, for instance, car scrappage schemes to encourage people to trade in their old cars. Well, these are temporary schemes. And in the UK, for instance, there's a VAT tax reduction that expires at the end of the year, and the tax goes back up again on the 1st of January. So all it does is bring spending forwards before it drops off again. And lastly, we have we've had a fairly significant increase in oil prices, and that will lead to that dents people's ability to spend. So I think we do. The situation is much better than it could have been. We were staring over the edge of the precipice this time last year with the collapse of Lehman Brothers and the potential collapse of the banking system. Well, I think the policymakers have saved us from that, and the stock cycle and the government spending means that we are seeing a recovery, and that's fantastic news. But there are all these factors that are likely to constrain growth in the medium term. If we look at the data so far, we can see to a certain extent that the countries that have been hardest hit are indeed recovering first. But it's going to be a long old struggle. I think this is a really telling chart, and in some sense the most important chart here. This shows the number of quarters for GDP, the amount of production in an economy, to return to peak level. Now, the best of the lot is the US, where we're looking at 6 quarters. That's 1.5 years. But lots of countries, or groups of countries, the Eurozone, I think 13 quarters, Germany, 14 quarters, Japan, 16 quarters, Italy, 18 quarters. This is years and years and years before their economies are going to recover to peak level. So, this is not wonderful stuff. It's a lot better than it was. We've avoided the catastrophe, but it's going to be a tough recovery. So it really means I can be a proper economist and say, on the one hand this, on the other hand that. We have a recovery. We've avoided a complete collapse, but it's going to be a fairly slow old recovery.